Hello and welcome to this quick analysis of Groww's upcoming IPO. If you are considering investing, it's crucial to weigh the opportunities against the challenges and risks. Based on the latest data as of November 2025, let's break it down step by step to help you evaluate what you are signing up for. Groww is a leading Indian fintech platform offering stock trading, mutual funds, derivatives, and more. Founded in 2016, it has grown rapidly, boasting 12.6 million active NSE clients and a 26% market share in broking as of June 2025. The IPO involves a fresh issue of 1,060 crores and an offer for sale for 7.62 crore shares, aiming for a valuation of 60,000 to 68,000 crores, or about $7 to $8 billion. Shares are priced at Rs 100 to 114, implying a price to earnings ratio of 33 to 37 times. Groww reported FY25 revenue of 3,902 crore, up 50%, a strong turnaround from its earlier losses, as the offer for sale benefits existing shareholders. It's just like the Lenskart IPO, where a good allocation is offer for sale. The breakdown for IPO includes 152 crores for cloud infrastructure upgrades, 225 crores for brand building and marketing, 205 crores for strengthening the NBFC subsidiary, Groww Credit Serve, 167 crores for the margin trading facility, and approximately 310 crores for acquisitions and general corporate purposes. This allocation supports tech enhancements, user acquisition, and diversification into lending and other areas. Groww's active users grew at an astonishing 52.7% CAGR from FY23 to June 2025. Over 80% of this growth is organic via referrals, keeping the costs low. However, SEBI's F&O rules have dented volumes, dropping brokerage revenue 18% in Q1 FY26 and risking additional 10 to 20% user decline, which could wane cross-selling. Let's evaluate opportunities against the challenges. Broking revenue dominates 85% of the total revenue, but mutual fund fees surged 69% to 320 crores and lending fees surged 409% to 280 crores via MTF and personal loans. Asset management, the AUM jumped from 7,068 crores to 25,199 crores. Let's now explore the future expansion plans for Groww. Groww explores wealth management for affluent users, commodities, insurance, and US stocks, with user stickiness aiding cross-selling in India's rising fintech market. The big challenge to these numbers are the SEBI's proposed reforms, wherein the brokerage fees is being cut from 12 BPS to 2 BPS, which may compress the overall fees by 5 to 10%, while the F&O could see 20 to 30% volume drops, shaving 10 to 15% of overall revenue in FY26. But RBI's scrutiny is expected to slow the retail credit growth from 29% to 18%. Its reliance on the broking revenue risks 15 to 25% hit if the sign-ups to the Groww's platform thin out by mid-FY26. Let's now talk about the competition and market risks for Groww. The IPO fund boosts scalability, but still, rivals like Zerodha, Angel One, and in broking, and Bajaj Finance and Paytm in lending have deeper resources. As the competition intensifies in FY27 and 28, and the loan book exceeds 5,000 crores in a 15 to 17% CAGR market, heavy broking dependency exposes downturns with historical negative cash flows. In evaluating the overall risks, diversification could limit net impacts to a single digit, bolstered by focus on affluent users and technological investments as buffer in this cyclical industry. However, in a pessimistic scenario where F&O volumes plummet by 30% and lending growth slows to 20%, revenues of Groww might fall 10 to 15%, eroding its profit by 4 to 5%. While the premium valuation at 33 to 37x PE leaves little room for error, potentially leading to post-IPO disproportionate akin to peers facing 20 to 50% revenue hits from a harsher regulation. As we all know, an IPO isn't a company's first choice, often avoided until really necessary due to regulatory burdens. In summary, Groww's IPO leverages India's fintech boom with a solid growth, enhanced by proceeds, but regulations and competitions temper the upside. Since the whole math doesn't add up completely, current pricing seems higher than what it should be. But as we all know, any price is right as long as someone is willing to pay for it. If you are a risk tolerant and bullish on diversification, consider buying this IPO. And last but not the least, keep an eye on SEBI's volatile stand to avoid shocks. Thanks for watching. Like and subscribe for more insights.